Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, recording this late Friday morning as usual on January 10th. And public service announcement, I will be doing a free webinar next Thursday, January 16th, 2 o'clock Eastern Time. So you can sign up for that at cabotwealth.com. If you can't attend live, I hope you can, but if you can't, we'll send you a recording of the video. I think the next day or two or so, it should be out. In terms of the market for the here and now, not much has really changed. We started the week out positive. We're kind of falling, as the week has gone on, finding a little bit of support this morning as I record this, but we'll see how it goes. Overall, the bottom line is there's a lot of details, but the bottom line is, by our measures, the intermediate term trend of most major indexes, the broad market, and leading growth stocks is down. If you want to say sideways to down, that's fine, but it's not up at this point, okay? And coming after a big run, one thing I'll talk about in next week's webinar, where I am bullish for the year, but for the here and now, the pattern of evidence in the last year, where you've had a couple big legs up, including the prior, August to December, a lot of speculation, quantum stocks, things like quantum computing, things like that. And then you've had some real selling pressure. That kind of tells me to be cautious, to remain sort of close to shore, however you want to say it, limit new buying, and just wait for the selling storm to pass, okay? Now, I will say a couple of things we'll take a look at. Defensive stocks, not in favor, so it's not like institutions are stampeding into like toothpaste and toilet paper at this point. And it has gone, this correction phase so far has been a month long, so sentiment has come in, and I am seeing some intriguing like intermediate term oversold measures. I'm not a big overbought, oversold guy, but just things I'm watching, so if this did go on for another week or two, you'd get some pretty legitimate, hey, this hasn't been seen in 2 or 3 or 4 years sort of thing. So we'll see how it goes. I do think a good 2 or 3 days, not just from the indexes, but from leading stocks, could really change the outlook. It is early January, but at this point, like I said last week, the onus is on the bulls to kind of step up, support some names at key levels, and not just support them, but start buying them and pushing some things out to new highs as opposed to selling on strength, which is really what we've seen for the most part over the past month. In Cabot Growth Investors model portfolio, we're up to about 60% in cash. I haven't picked that number and said we need to be 60%, but we just haven't been buying anything and have been sort of trimming we've taken partial profits like it's going out of business and paring back and kicking some names out, and we're up to 60% cash. We could, like I said, a good few days, say next week was really good, really broad participation, some things moved to new highs. We would probably put a chunk of that to work, but we have to first see it to believe it. Right now, I'd favor be defensive until the market can get up and going. Okay, let's hop into the charts. As usual, I'm using a program called Market Surge. It's a product of Investors Business Daily. You can learn more at marketsurge.com. So starting with our major indexes as always. So the NASDAQ is the best looking one. As I record this, it got hit today. Jobs report, interest rates are up. We'll look at interest rates in a second. And it dipping below the 50-day line. So it's finding some support. We'll see. I'm all for, hey, we close, we close way up here and it's some huge volume support day and individual stocks look great. I'm all for it. But just looking at, not just the last couple hours, the last couple days, it's been chopping sideways really since mid-December. Can't get over this 20,000 level, a little bit below the 50-day line. And that's the best index, okay? The S&P 500 starting to live, for the most part, live below the 50-day line. You can see, and as we talked about last week, the broad market's kind of a mess. I mean, this is small caps, which granted are kind of the worst of the worst, but they're already 11% or so off their high, okay? So this is like an 11% drop, which that's not too good. The others aren't as bad, but even so, like mid caps, they're just kind of walking the plank a little bit, like they had this big decline, and they really haven't been able to rally much, okay? New York Composite, same sort of thing. And then when you broaden it to, just equal weight, like the equal weight S&P 500, again, it's kind of testing new correction lows today, okay? So, I'm not saying that the NASDAQ or the big cap indexes can't lead the way higher if things turned up, but I just feel like at this point, they're just kind of masking what's really going on. It's not just small caps are lagging. It's really just everything but, some of these big cap stocks, okay? QQQE, which is the equal weight NASDAQ 100, not as bad as some of the others, but again, it's actually testing the 200-day line and really just can't get out of its own way here in the last couple of weeks. And then on the more growth-oriented side, this is the IPO fund. Same general picture. Just can't, at best you could say, well, it's the low end of the trading range, but just can't get going, living below the 50-day line. And even something like the IBD 50 index, which is not perfect, And the chart's a little bit messy, but it's just kind of living right near the 50-day line. So like I said, you could call it neutral if you want for some of these. You could call it negative, whatever, but it's not up. You can't sit here and say every day when I come in, there's usually almost every day, there's usually like 1 or 2 or 3 stocks I own or we're watching usually that are just getting dented, maybe breaking through support, not looking too good. And at this point so far, it's very rare to see something like, oh, wow, that broke out on the upside. We'll mention a couple here that are resilient, but right now, like not going down is sort of like the gold star for most growth stocks, okay? The other, I can't pull it up on this, but you could pull it up on stock charts if you want. But as of this morning, I don't know where we closed, but 80% of the S&P 1500, so that's the big cap, small cap, and mid cap indexes combined, the S&P 1500, 80% are below their 50-day line. Again, that's kind of oversold, so I'm not saying that's predictive, but it's descriptive of just telling you that there's not a lot of stuff that's really holding up and ready to get going, at least at this point. Getting in here to interest rates has been the big bugaboo. Okay, now again, today we're kind of maybe finding a little resistance, but this is the 10-year note. This was that 450 level. I had talked about this weeks ago. There's no science to it. It's just a round number. And I was just thinking like, hey, if we got above 450, we started talking about it back here, it could present issues for the market. And sure enough, once we did here in mid-December, it's presented issues for most of the market, maybe not the big cap indexes as much, okay? We'll see what happens. Listen, if the 10-year note goes to 5.5%, 6%, I mean, the market is almost definitely going to have issues. I mean, it's going to be bad. But, let's just see how it goes. There is resistance up here if you look at the weekly chart. And I'm not going to get into, I'm not a big chartist when it comes to rates or whatever, but the old high during this cycle was 5%. So there is resistance in this area. There's resistance from a few months ago that we're sort of testing. So let's just see how it goes. Maybe this is sort of a peak in rates and we come back down and all's well with the world. But again, you kind of want to see it to believe it. In terms of the sort of ray of light, I guess the main ray of light to me, and again, you can always make excuses. It's interest rates. It's because of the US dollar, whatever. But this is the consumer staples fund. If the Fidelities and the T. Rowe Prices and the whatever of the world wanted to, the BlackRocks and all this, if they wanted to go into defense, I'm not saying the XLP would be soaring to a new high necessarily, but it would not be falling day after day after day, sinking below the 200-day line. You know what I mean? And just to a lesser extent, the utilities, obviously they're buried, certainly not really outperforming the market. The healthcare is a little bit, they had some political stuff going on there, but it's not like we've seen some big ramp, a little bit of strength here this week, but since the turn of the year. But, it's not like we're seeing a huge rush into defensive stocks. Does that tell you that this correction is going to end, today and we're going to start buying next week? No, it doesn't mean that at all. But it is a sign that it's not like big investors are selling growth and going heavy into just the most defensive stuff because they see some huge problem ahead. It's more just kind of a general selling wave after what was a very good year, and we just have to wait for it to play out. It might take another week or two. It could take a couple of months. We'll see how it goes. Like I said, we're already a month into it, which I think is a positive, although I don't think a lot of people are thinking that way. So there's probably some more damage to go, okay, and then we'll take it from there. In the meantime, it's just about keeping your feet on the ground, in my opinion, staying defensive, but keeping your watch list up to date. When we get going, the good news about this is the wheat is separating from the chaff for growth stocks and for the market as a whole. And we do have earnings season coming up, so that process will accelerate in terms of seeing what's really strong and what's not, okay? Just going from all over the market here, I'm going to start with airlines, which I know is everybody's favorite, but this is Delta, DAL. You can see that it's actually been a little bit of a laggard in the space short term, but reported earnings gapping up nicely. There's others that look good. United Airlines has been sort of the leader. And the one thing I would say here, which is kind of intrigues me, is the stock. I'm not going to count it right now. I want to say it was 17 weeks up in a row. I could be off by a week or two. And coming after a period of, death where the stock did nothing for, years. That's kind of an interesting turning point. Now, it's a cyclical name. It's an airline, so I'm not going to get ahead of it. But at the same time, it's a nice pattern here, nice test of the 10-week line moving out to new highs. So the airlines are kind of a strong group. Into growth. So this is DoorDash, which I've mentioned before, Dash. It doesn't look great. Like if you look at the, if you look at the day-to-day, it's just kind of slopping around. There's resistance up here. But again, you just kind of step back, especially with a weekly chart, which I've mentioned this 100 times, but it broke out. It had 9 weeks up in a row. When you have a bunch of weeks up in a row, it's just a sign of persistent buying, obviously. And you see that in the market a lot, but usually when you get a big liquid name that's early on, it breaks out and goes up 9 weeks in a row. I'm not talking like after it's been running 4 months. That can be more of a sign of a top. But this breaks out, whenever this was, September, 9 weeks in a row, and it really hasn't given up anything. I mean, it's 6% off its high. Now, maybe next week the thing, craters or something like that. They have earnings coming up, well, not till early February. But overall, this looks pretty good. And this is one name where, again, when I was saying if there's a couple of good days, say the market gets going, boom, boom, this thing's at new highs, okay, way ahead of the major indexes, especially the broad indexes. So DoorDash is a name that's on my watch list. GE Vernova is another one. So this one, we've seen a lot of selling on strength, no surprise. In a correction, you tend to kind of hit new highs, and then the people sell because they want to, pare back. GEV, has had this beautiful straight sideways thing, did pop to new highs this week. Pretty good volume, not overwhelming. And since then, they've been shaking the tree. Interestingly, the stock has so far held, not to get too close to the market, but the stock has held the 350 area, which is, a good sign so far. It easily could get pulled in if the market gets, really gets weak from here. But certainly so far so good. It certainly looks like it wants to go higher. It's just a matter of whether the market will let it. Robinhood, this was kind of intriguing because let me just look at here's BlackRock, BX. Okay, this is obviously a kind of a granddaddy bull market stock, a little bit more tied to real estate and interest rates, but still. KKR, really one of the leaders of the space, private equity, but these are bull market stocks, what I call bull market stocks. Kicked off in November 2023, and it's really been a pretty good ride here. That looks pretty, intermediate term toppy. We'll see how things go. Even Apollo. The point here is that the group has been fading, so I actually hadn't looked at Robinhood in a while. Don't get me wrong, the stock is very, very choppy. I mean, it went from 44 to 34 in a couple of days, but overall it's been hanging around here at the 25-day line. The recent breakout, the stock, quote unquote, only went up, including this shakeout. It only went up 9 weeks. And since then, it's been this is the 5th week of going sideways. Now, again, if the market stays weak, all bets are off. But the longer something can kind of hold up in here, the better. It does kind of trade with Bitcoin, so, buyer beware on that sense. But just going with the evidence so far, so good on that. And I'm just going to mention Reddit again. Reddit, the stock doubled, basically toyed with new highs. So it went from 80, more than doubled, went from 80, gapped up, and went up to 180, round numbers. So 80 to 180 in 2 months. And since then, again, it's volatile. Don't get me wrong. There's some selling this week on pretty low volume. It's about, I know there was 1 day off, but about 50% of its average. And the stock really hasn't, 11% off its high, but you just see on perspective, it's hanging around the 25-day line as I record this. There are RP lines right here. So I just find it very intriguing that they keep throwing shots at growth stocks, at the market. Yes, the stock will dip 10% or something like that, but on the big scheme of things, so far so good for Reddit, okay, which I do find intriguing. I'll mention A-Lab as well, although there's some others I'm going to mention. This is another, networking play here. But again, these hot stocks, the longer they can kind of hold up and not really give up the ghost yet, the better, okay? On the sort of the networking theme, the AI networking theme, I'm still impressed. Again, we're getting to the point now where it's like, oh, when this thing gaps up here, you're like, what are you going to do with it? You're going to buy it up here? It's way extended. It's not like it just broke out. It's not like the market just got going. It's just kind of, sitting up there. But here we are 5 weeks later. This is CRDO, and now it's still kind of hanging up with its highs when a lot of growth stocks are, breaking down and stuff like that. So I find that pretty encouraging. Marvel Technology, MRVL, kind of a similar vein. Again, you get these big shakes right here when things are ugly, but net, it's holding around the 25-day line, which, you would know that growth stocks are really getting kicked in the teeth here the last few weeks, okay? Geo Group, again, this is sort of the deportation play. If it's not your cup of tea, don't play it. I'm just trying to bring up nice charts and opportunities. You kind of had this, 3 weeks up after the election, and then a very, very tight range here, and then kind of a breakout this week. We'll see. Again, the breakouts in this environment tend to be like we saw with GEV, goes up for a day or two, looks great, and then comes back down. If the environment changes, maybe this can run. But so far, obviously, so good. Not huge volume on the breakout, but obviously acting well, especially given the environment. Taiwan Semiconductor, I'm mentioning this in Growth Investor today, which got published a day late because of yesterday's exchange holiday. But again, just kind of a base on base here. It did break out, selling on strength, comes back in. This is kind of what you see in this sort of a situation. But overall, it's just, it's still kind of trending higher here. And again, the way I look at these stocks is just like, hey, if the market kicks into gear, if growth stocks kick into gear, if perception changes, if this is a early January shakeout on top of the December weakness and we get going, this certainly seems like something that could get going from here. It does have earnings next week on the 16th on Thursday, so that's, kind of a risk. But I certainly think the setup is there. Medical name, I'm going to throw a lot of names at you. Medical names are holding in there. I wouldn't say, again, they're not racing higher necessarily. This is Insulet. We had this as actually a top pick. I think it was a top pick in top 10 back here, and it just never got going. It never really did anything wrong. But anyway, we got out around even or small loss, small gain, something like that. But you can see it's just been very, very tight in here, just like it was very, very tight back here. This is like a insulin pump maker. So a nice tight area here. And again, 1 or 2 days from here, and you're looking at new highs, okay? Earnings for a lot of these aren't out until probably mid-February, okay? RDDT, this continues to look good. It's been kind of an odd performer where it's been trending higher, but you can see relative to the market, it really didn't outperform. That's not bad. It was doing fine. It just wasn't a super leader. That's begun to change here in the last 3 weeks, obviously, as the market's corrected. And we've seen some buying here come in, on the after the calendar flip. Not huge volume, but so far so good. RGX. And then I have to mention NTRA. This stock has had a huge run. You can see it kind of kicked off back here and just has been, there's been shakeouts, but it's just been running forever. So it's not my favorite situation, a little later stage in that sense. But again, the longer you hold up in an environment like this, kind of with growth stocks getting hit, the better. And this thing keeps toying with new highs. They're really not hitting it much. It had one bad day here in December. That was about it. So NTRA is another name. Just a couple more. Two more. Boot Barn, I'm just mentioning this. This is a retail play. Again, it kind of broke out, had an extended run over, call it 6 months or so. And then it got hit on earnings, and it was kind of like, okay, this is done. But it had one bad week on earnings. This is the weekly chart. And since then, it's just been crawling higher, crawling higher, crawling higher. It's kind of getting to the point here where, there's resistance in here, so maybe it dies. But the fact that it really had, you can see literally 3 days down, and then it's just kind of been trending higher since then. So I kind of find that interesting. It has had a good story. Earnings are turning up. The future numbers are good. And it kind of needed to shake out the weak hands. It probably did. So if this thing can come out to new highs in a healthier environment, it would be intriguing. And last but not least, sometimes I like to save some oddball things for the end. This is XOP. This is XOP, which is the, and you can throw in OIH. These are just the oil funds. XOP is the explorers. OIH is the servicers. It's just been out of favor for a while. And there's not much to look at yet. But sometimes when you get a group that's been in the doghouse, the calendar flips or around then, and then it really rushes higher, it can mark a turning point. So it's just something I'm watching. It's early. It's still below the 200-day line. But I do find it interesting that kind of held support in here. It's been rushing higher, and everybody has hated oil. And by the way, oil prices, I think they're reversing today, maybe. No, they're coming back in. But oil prices have been, this is the oil fund, they've been going from, high 60s to mid 70s. So the fundamentals there are improving. If cyclical stocks start to work, we'll see how it goes, but just an idea. Back to the market, like I said, it's not 2022. It's not 2008. It's not like, just go skiing and come back in a couple weeks. We'll see what's going on. No, I do think, I wouldn't say 1 or 2, but if you had like 3, say next week was a really good week, broad participation, a few of the stocks I mentioned here popped to new highs, I would be intrigued. I'd put some money to work and see how it goes, okay? But we have to see it first to believe it. Right now, it just seems like, growth stocks got hit first after huge runs. The broad market got hit, and has stayed down. And now it seems like maybe some of the big cap indexes might be joining it's not a party, but joining the correction here on the downside. And we'll see how it goes. Sentiment has come in quite a bit. There are some oversold indicators, so I'm staying flexible, but I'm also staying defensive until the market proves that it wants to go higher again. Okay, that's all the time I have for today. As always, thanks for listening. Be sure to go to my webinar next week, next Thursday, January 16th. You can sign up at cabotwealth.com. And again, come by again next week for another Cabot Weekly Review.